Today's video is part 2 of an interview I did with Caleb Guilliams of Better Wealth. In this part of the interview, I compare whole life insurance to index universal life. I discuss buy term and invest the difference, whether life insurance can replace the entire retirement portfolio, if the 4% rule is still valid, the dangers of owning an annuity in the tax-deferred bucket, the risk of 401ks and IRAs in a rising interest rate environment, and my advice for 30-year-old investors.
One thing I want to go into, and we can talk unfiltered. I know that you're a big fan of Index Universal Life. I think that's another way of saying LIRP. And we do a lot of whole life, which might seem old and archaic, but we deal with a lot of entrepreneurs that want high liquidity, don't necessarily want a ton of variables, and they borrow against it. But like, I've had people on both sides of the aisle, and I think it's really, really important to have the dialogue. Can you talk about when you would ever use whole life, or are you just being polite and saying I'll say whole life because I'm on a show with Caleb? But like, when is, like, what are some of the pros and cons in someone doing the research, whether they're a consumer or an advisor? What should they look into as it relates to this topic?
I know that people, I don't know if you're an advocate of infinite banking or not. I know that whole life and a particular type of whole life works really, really well with infinite banking. And when people need predictability and they need to know exactly what their cash value is going to be in a given year, then whole life can be very effective. It can be a great bond substitute, so on and so forth. I tend to like index universal life. I think you get slightly higher returns. I also love the fact that, to me, one of the most important provisions in the entire LIRP contract is the loan provision. And the one thing that I know about Index Universal Life is that there's some companies that guarantee a 0% loan provision. So as a rule, all LIRPs are tax-free, but they're not all cost-free. And where do life insurance companies make money on this? By charging you a net rate of interest for the loan when you take the money out. So what I'm looking for is a contract that's both cost-free and tax-free. I wrote a book called Look Before You LIRP, where I show what are the implications of having a loan that's not 0%. And so that said, there are contexts in which whole life is a superior product. And so I'm not here to knock that down or in any way denigrate whole life. I just think it just depends on the context. And for the type of planning that I do, which is people between age 50 and 67 that are looking to build money up, take money out, do so in a tax-free, cost-free way, get a death benefit that doubles as long-term care. It tends to work really well for that context.
Yeah, and I appreciate you saying that, because one of the things that we have to do is look at the result and then reverse engineer that. And it's important, especially when you're using a life insurance contract that's multidimensional, to look at all the dimensions, because a lot of times, again, we say life insurance is not for the rate of return, but that's the thing that we measure everything against. And there's different riders that enhance certain contracts and others. And so I appreciate you articulating that. One of the things go on.
I was just going to say real quick that one of the things that people have to remember is that when you read The Power of Zero and you hand the Power of Zero out to a client, it's a really agnostic when it comes to which product you use. Some of the people that buy my Power of Zero, the most are people that sell exclusively whole life. And so as far as the Power of Zero goes, it's really is agnostic when it comes to which product you use.
Yep. And the message is really, really important. And I just want to echo the importance of not having all your eggs in one basket. I think there's a ton of wisdom in having multiple different streams that are tax diversified, because again, we in Wall Street like to focus on diversifying your risk, but we're not diversifying the tax risk, which I think is insane. But then also just not having all your eggs in one basket. I want to talk about buy term and invest the difference. You have a phenomenal video on your YouTube channel about this, and I think you articulate it well. When someone says, Dave Ramsey, Susie Orman, some of our other favorite gurus out there, they're saying buy term and invest the difference. How do you address that? Is you ask a question? Do you point something out? Again, I think we can link your video in the description, because I think you did a really good job on YouTube. I wanted to give you another way to articulate it on the show.
When people sort of portray life insurance, permanent life insurance, as a ripoff, they particularly Dave Ramsey, they tend to give you the following example. They'll say, hey, if you were to put, say, $10,000 per year into a permanent life insurance policy growing at such and such a rate, after 20 years or 30 years, you'll have, say, $1 million, just to pick a random number. However, if you were to take that same amount of money and grow it in an index mutual fund or some sort of mutual fund that Dave Ramsey might recommend, and get, instead of what you could get in that life insurance policy, maybe you get 8% or 10% over time. Instead of having $1 million after that time frame, maybe you're going to have $1.5 million or $1.7 million or what have you. And so then, that's how they lay it out. And they say, so by choosing that permanent life insurance policy, you just made a $700,000 mistake or $1 million mistake. And that's really how they quantify it. And it's incredibly misleading because when they do that comparison, there's a couple of different expenses that they don't include on their side of the ledger. They don't, when you say buy term invest a difference, presumably you are going to actually buy term and calculate and include the cost of the term insurance in the calculus. And then investing isn't free. And if you look at the average cost of investing, we're talking 1%. So when you actually figure, you calculate in the cost of the term insurance and how much you're able to actually invest, net the cost of the term insurance, and then you actually figure out what the expense ratios are over the life of the investment, horizon, then you're not really going to be that much better off. And the second misconception that they have is that life insurance is in competition with a stock market portfolio. It's not in competition with a stock market portfolio. So you say, look, I can get 10%. And you're only going to get 4%. Well, guess what? In a balanced portfolio, what if we were to take that life insurance, replace your bond portfolio? How much further ahead would we be? And so when you do an apples to apples comparison instead of all fruit salad, it tells a completely different story. So there's all sorts of different ways to manipulate the narrative. And people that have an agenda and they have a narrative that they have to uphold, they're very, very good at casting this in a very derogatory way. And my job is to simply say, hey, look, let's be fair. Let's not illustrate fruit salad. Let's do a true apples to apples comparison. And what my video attempted to do was just to simply show the right way to do the comparison.
Yeah, and I also like what you're saying. It's not an either or. There's a lot of and. It's not saying you're anti-market at all. It's like,
right.
Let's look at the most effective solution. And it's interesting. We say the word retirement, which is kind of a swear word around better wealth, but the idea of retirement, let's call it what you actually want, a future cash flow plan. And if we started calling things future cash flow plans, and then we started measuring, I can't spend a rate of return. I don't necessarily care what the rate of return is. What cash flow is this going to give me? Then we would start making different decisions, across the board. And I think if I could do anything or encourage anyone when it comes to planning, it's think with the end in mind. And so you're a big tax person. So you're saying let's not just look at the gross number, but let's look at the net number after tax. But can you talk to the distribution planning? Because a lot of people, when we throw out things out 4%, and now people are saying it should be lower than 4%, that's a huge problem. Even if taxes lowered or stayed the same, which they're not, but if they did, even with that, the typical approach is not that effective as it relates to having cash flow in the future.
Yeah, so we're talking about sustainable rates of return then?
Yeah, it's sustainable rates of return on distribution.
Yeah, so this book right here is the sequel to that book right there. So Power of Zero is what started it all. And this is both are through Penguin Random House. So this basically says, this book right here says, we know that tax rates in the future are likely to be dramatically higher than they are today. How do we best insulate ourselves against that? And then this says, okay, how do we avoid the number one risk facing retirees these days, which is in survey after survey, they tell you, the fear of running out of money before they run out of life. How do you do that? Well, there's two ways to do that historically. One is to simply try to obey what they call the 4% rule, which was invented back in 1992 by, now I'm going to draw a blank on his name, which I quote repeatedly in my book, but he basically said, look, if you do Monte Carlo simulations, there's really a sustainable amount of money that you can take out of your portfolio year over year without running an unduly high risk of bankrupting yourself before life expectancy. And basically, he said people that take out even 5% per year have 50% failure rates. And so he basically said, look, let's take out 4% per year. You get about an 85% likelihood of not running out of money before you run out of life. But when you utilize annuities, that tells a completely different story. Annuities can help you take out a much higher percentage year over year for the same amount of money. And so when people are relying on the 4% rule, or what people are now saying today is the 3% rule, it is a very, very expensive way to go about guaranteeing, or at least mitigating the risk of running out of money before you run out of life. It's much less expensive to do it by way of an annuity. But part of the issue is historically when people do annuities, they stick it in that tax deferred bucket. And so while they're mitigating longevity risk, they're not solving the tax rate risk problem. And so what I talk about in this book right here is how to mitigate tax rate risk and longevity risk in the very same financial plan. And so there's ways to do it, and annuities figure very prominently in the calculus.
Was Bill Benyon the one?
It's not Benyon, it's okay. Bill.
We'll get in the show notes.
We'll get it. If I have to crack open my book, we'll do it.
Okay, so I wanna talk about a few things. This has been amazing, by the way. I appreciate how articulate you are. I want to talk about, if you look at the next 5 years, you look at interest rates going up, which is problematic when you look at our debt, because doesn't that increase the debt service? So it's interesting how high the interest rates can go because our country's kind of handcuffing themselves. So number one, how is that going to affect? We look at house prices. Not that you're giving any advice, but any thoughts on that? And then any other predictions that you want to say in the next year or two? These are some things that I see happening that are going to affect your bottom line and your wallet.
Yeah, so we sort of painted ourselves into the corner with the stimulus from COVID. You borrow $6 trillion all in 1 year, and all of a sudden you've got a lot more money that's swimming around in the economy, a lot more dollars chasing a lot fewer goods. So that's a combination of Ukraine, the stimulus spending, and the supply chain crisis is driving inflation up. So what does the Fed do to combat inflation? Well, one of the tools they have in their tool belt is to increase interest rates. And any economist will agree that when you increase interest rates, you increase the cost of servicing the national debt, which means that as national debt grows, as interest rates slowly return to historically normal levels, we're going to find ourselves in a position where the cost of servicing the national debt will consume the entire federal budget, which means there's going to be nothing left to pay for Social Security, Medicare, Medicaid, just the cost of running the federal government. They're going to need huge infusions of cash. They're going to be looking in all quarters to find more money just to be able to keep themselves afloat. And so we're marching into this future where, what are we going to do? Are we going to borrow more money at these high interest rates to be able to bridge the gap in our, fill the hole in our budget? Or are we going to have to find revenues in new ways? And are we going to have to raise taxes in order to find that revenue? And I think more and more experts are agreeing that we're going to have to raise taxes to be able to solve all these financial issues, which is a problem for people who have accumulated the lion's share of their retirement savings in highly taxable vehicles like 401ks and IRAs, because essentially they've gone into a business partnership with the IRS, where every year the IRS gets to vote on what percentage of your profits they get to keep. Not a very good business partnership, if you ask me. And so it really is problematic. And as interest rates go up, fewer people are going to be buying homes, which means the cost of homes are going to start to drop. So there's all sorts of unintended consequences associated with our current fiscal trajectory.
Yeah, and there's so many follow-up questions, but I think again, you articulated the unknowns well. I guess my question is, if you're 30 years old, because I know that you guys are mainly serving people that are nearing retirement or in retirement, is if you're 30 years old listening to this, knowing what you know and knowing that you don't know 30 years from now, what advice would you give somebody knowing that where interest rates are at, where the debt's at, where the looming taxes could be? Like, what advice would you give a 30-year-old that's listening to this and maybe a little bit depressed, because it's like, what's the point if it sounds like our government's going to self-sabotage itself?
Yeah, so a couple of thoughts. As a general rule, the younger you are, the more inclined you should be to contribute to tax-free. The farther your investment horizon is in the future, the more likely that tax rates are going to be higher for you in retirement than they are right now. Remember, if you're 30 years old, you're at a low marginal tax bracket, you put money into your 401k, you're getting a deduction at a low marginal tax bracket, only to postpone the payment of that tax till some point much further down the road, and you're going to pay the tax at a much higher rate. I mean, the math just doesn't add up. And so the younger you are, the more it makes sense to invest tax-free. Now, if you're rapidly approaching retirement and you say, look, I don't think tax rates are going to go up in the next 5 years, fine. I'm willing to argue to a draw on that one. But if your horizon is 30 years in the future, I don't think there's any question that your tax rate is going to be much higher than it is today. And every single projection, every single math calculation I've seen bears that out. So I think that if you're sitting there saying, should I get the tax deduction by putting money into my 401k, or should I pay the tax today and put money into my Roth 401k or my LIRP or what have you, so that years down the road, I've done all the heavy lifting and I can then take that money out tax-free. I think it's really a no-brainer at this point.
Is it fair to say look for permanent reductions in taxes? So tax planning is very, very important, but don't defer or postpone to an unknown date with an unknown threshold, with an unknown governmental person in power. Like it's very risky.
Yeah, I think you put that very well. I mean, you're exposing yourself to a whole bevy of unknowns by postponing the payment of that tax. Do the heavy lifting today. I give you permission to not enjoy it. Forgo the tax deduction, pay the tax today, so that years down the road, you don't have to stress over what your tax rate is going to be. If you need some help implementing any of the strategies I discussed in this interview, head on over to davidmcknight.com and opt in for a complimentary strategy session. I'm happy to give you a hand. Don't forget to click like, subscribe, and the bell so you never miss a video. And feel free to make comments or ask questions in the comment section below. This is David McKnight. I look forward to seeing you on the next video.